Affairs of the American Supply Association. Today's webinar will be focusing on the upcoming changes to overtime regulations that go into effect on December 1st. Our presenter today is Bill Ford, President and CEO of SESCO Management Consultants, a firm he has been with for 26 years. Bill is a human resources management consultant specializing in family business consulting, compensation, wage and hour, EEO representation, organizational development, labor relations, and compliance to federal and state employment regulations. He has authored a number of publications, including How to Develop a Compensation Program and How to Comply with Wage and Hour Regulations. Bill can be reached at SESCO's offices at 423-764-4127 and by email at bill@sescomgt.com. Before we begin, and I turn things over to Bill, I want to recognize the great companies that can be seen here in the next slide. That can be seen here that are part of ASA Supplier Partner Program. Without their support, many of our programs and services would not be possible. Finally, as a reminder, this webinar is being recorded and will be available for future viewing. And most importantly, if you have a question, please feel free to type your question in the question or chat box at the bottom right of the dashboard, and we'll do our best to get that answered. Over to you, Bill.
Dan, thanks so much, and also thank you and Ben so much for the kind invitation to be able to present this information today. What we're going to do is we're going to walk through basic wage and hour regulations. I'm going to try to tell a story that will help us get prepared for these changes come December 1st. But as I've referenced to Dan and the team there at ASA, what we're covering in about an hour or a little less is highly technical. You may have more questions than you did before, and our commitment to the association is that as you have questions, certainly we can answer those at the end of the program, or better yet, if you would prefer, simply call us. That's why Dan provided the phone number, 423-764-4127, or email me, and we'll be happy to discuss those questions. We're going to do so at no charge, so don't worry about any fees. We want to make sure that we get your questions answered and get you taken care of. So that's our commitment as part of this relationship. So a little bit about SESCO. We were founded in 1945. We do represent clients across all 50 states. And we reference, in particularly 1955, not only are we proud of our history, but it's interesting to note that our founder, Dr. J. W. Lawson Sr., worked for the Department of Labor Wage Hour Division in 1944, back then enforcing new regulations. Minimum wage was 25 cents an hour. New overtime minimum wage rules and regulations. The Fair Labor Standards Act was implemented in 1938. So SESCO, if not the first, was one of the first consulting firms assisting business and industry to comply with these regulations. It's also interesting to note that you would think after all of these decades that this piece of legislation would not be such an issue for employers. But as you can imagine, in your own business or otherwise, these regulations continue to prove to be costly. In fact, fiscal year 2015, 14, and back several years, non-compliance liability, financial liability, fines issued, back wages issued for wage and hour regulations or non-compliance thereof was the #1 violation, or has been the #1 violation for employers across all states and all industries. It's not harassment, sex harassment in particular. It's not EEO discrimination charges. It's not OSHA and all the other things that we have to be concerned with as employers. But the #1 challenge has been wage and hour. So even after all of these years, we're still dealing with it significantly. And of course, come December 1st, we think this trend will obviously continue. So it behooves us to, as an organization, as a business owner, as a manager, as a human resource manager, to understand and comply with the regulations because non-compliance is costly. I sarcastically say this: if you want to find some interesting reading, go to the Department of Labor. Simply Google Department of Labor wage and hour. You can go to their website, and this next slide comes right off of their website, and it talks about how effective they were as a department of the federal government in 2015 in terms of the $246 million in back wages collected on behalf of 270,000 workers. In particular, there in italics, as they state, another year of meaningful progress toward our goal of ensuring a fair day's pay for a fair day's work. So they are very aggressive, and they're very proud of what they do. The next slide, again, is off of Department of Labor website. You're going to see that where they conducted an investigation, that 79%, basically 8 out of 10 employers, were found of some violation. So more than likely, if the Department of Labor comes into your business and conducts an audit, they're going to find something, as you can imagine. And based on those violations, they average about $9,000 per employee. So it can get pretty costly pretty quickly. Some other statistics, as we talked about, back wages for 2015 collected about $246 million. Complaints registered about 22,000. Concluded cases about 28,000. So again, it's a very active agency, and we're going to continue to see this wage and hour division be active. So the next question we typically get from our clients is, well, Bill, we hear you. We understand we have to comply with these rules and regulations. We understand that they're complicated, and we understand that the government is very aggressive right now. But how would we, as an employer, as an organization, how would we typically be audited by the Department of Labor? And 2 ways, typically. The first way that you would be audited is the one that we would hope. Of course, we don't hope or wish any audit on anyone, but you'll understand after I describe the 2 ways. But if you're ever audited, we would hope that this would be the one. And this is where you have maybe a disgruntled employee. Maybe we've held somebody accountable for attendance or otherwise. Maybe if it's a millennial, and I've got a 26-year-old and a 22-year-old son and daughter, so I understand. Maybe they're just out there online, and maybe they want to know their rights and or enforce their rights, if you will. So this disgruntled employee, or maybe an employee who has been terminated, or maybe just an employee who is curious, they may call the Department of Labor. And the Department of Labor at that point will ask some basic questions. But you need to understand that that investigator at that point assumes that that employee, ex-employee, whoever it might be, has a legitimate complaint. They're not asking a lot of tough questions about pay plans, how they're paid, overtime, minimum wage, and those kinds of things. So at that point, the Department of Labor is going to process that intake, basically finding out who the employer is, location, phone numbers, etc. And that investigator, or the call will be assigned to an investigator, will simply call you. In fact, I've even had them call phones, called on home phone numbers, etc. But anyway, they will contact you as the employer and let you know that next week or in 2 weeks that they will be in to conduct an investigation and to have certain materials available. At that point, there's not much that you can do other than, or should do, is just prepare for the audit. You can contact us or maybe another firm that would represent you to help prepare for. There's some tricks, not tricks, but some recommendations we would have to help you prepare and maybe head off some issues. But the reality is they're going to come in and they're going to go through your records, payroll records back 2 years as a standard practice. They may also interview employees. You will set up a private room for that investigator. No one can be in there other than the investigator and the employee, and they will ask certain questions. And let's say you're one of the 80%, as we just referenced, that has some sort of violation. And typically the violation is not minimum wage. Most organizations don't have any concern or issue with minimum wage. But typically it is overtime not paid correctly, or someone who is due overtime that didn't receive overtime. If they find that violation, then they will go back, again, 2 years, and they will find all affected employees and past employees, anybody that's worked for you in the past 2 years. They will calculate the overtime or back wages due. You do have some opportunity at that point maybe to present an argument, but they make it very difficult for you. And then they'll tell you to pay these folks what they're due, and in fact send the canceled check to them so that there is some proof that their payment was made. So you're looking at 2 years liability, going back 2 years. Now, sometimes the Department of Labor will go back 3 years and look at your payroll records back 3 years. But that's for what we call a willful violation, meaning that probably the Department of Labor has been in your business before, has conducted an audit, found you in violation, and you made no changes and said, the heck with them, we're going to continue to do this, they're never going to come back in. And lo and behold, they do. They come back in and they find that you willfully violated. So they can go back 3 years. So that's one way. The second way gets very testy, very expensive. And this is where an employee says, well, I'm not going to call the Department of Labor. I'm going to call an attorney. And this attorney then will process the case very similar to that as the Department of Labor. That attorney will start calling other employees and basically sign employees on to class action, if you will. And again, if there are violations found, your liability then, a legal case to the state, is the 2 years back wage liability, just like the Department of Labor, but also automatically you've got another 2 years that you're going to pay these employees for liquidated damages. So now you're at 4 years, and then also you as the employer are responsible for paying the employees' attorney fees, which can be astronomical. So it gets expensive very quickly. So those are typically the 2 ways that you would get in trouble. Now, not always are these complaints. Although the Department of Labor will not admit to this, they have and do target certain industries and certain areas of our country, and they will do or conduct random audits. And as such, certainly an investigator could simply knock on your door one day and ask to review your records. But typically it's through employee complaint. So that's how you get in trouble, or how you get audited, if you will. You may be in compliance and may not be an issue. And then that's the liability back through the Department of Labor or through a lawsuit. So let's start from the beginning, and I think it's important that we start from the beginning so that we understand the rules and regulations before we make any hasty changes based upon the new rules coming forth in December. We found over the past 6 months, in fact, in our auditing practice, that there's lots of misunderstanding, misconceptions, and what we want to do is make sure that we have the basics down pat before you make any further changes that aren't appropriate, further making things worse. So although the Fair Labor Standards Act, again, implemented in 1938, although it's several hundred pages long, basically the Act, what we're talking about, requires 3 basic things. And you all understand this, but as a reminder, the Act requires that employees receive minimum wage. Of course, federal is $7.25. As you all may know, and certainly if you're in one of these states, many states, or maybe up to almost half of the states, have implemented their own higher minimum wage. And in fact, we see some metropolitan areas such as San Francisco or counties in Maryland or other cities and counties implementing their own minimum wage. But anyway, we have to pay minimum wage, whatever the greatest is, but currently federal is $7.25. The employee must maintain an accurate record of time. Back in the day, it used to be by hand. card punch. Now, of course, there's all kinds of electronic means. It doesn't matter whether it's by hand or as fancy as you want to maintain, just as long as there's some sort of accurate record of time worked on a daily basis. And on a federal basis, the employee must receive overtime at time and 1/2 their regular rate for hours worked in excess of 40 per week. Again, there are a number of states that require additional overtime over 8 or on the weekend or on Sunday or for holidays, so be familiar with your state. So the question then becomes, based on the regulations, the Fair Labor Standards Act, what positions do we have that are considered exempt, particularly from the minimum wage or, more importantly, the overtime rules? What positions we have that we can implement a guaranteed salary basis without overtime? And again, as you all are all familiar, I'm sure, there are what we call white-collar exemptions, or what the Department of Labor calls white-collar exemptions, that they've issued that are within the Fair Labor Standards Act. You need to know that these white-collar exemptions have not changed. We thought there were going to be some tweaks, some changes, some revisions, but they did not do that. The only change, and the most important change coming December 1st, is the guaranteed salary basis. And that is moving it from $23,660 a year to $47,476. So I'm going to stop right here because this is the most common question or misconception, and you're going to hear me state this multiple times throughout the call. To be exempt from overtime, to be able to place someone on a guaranteed salary and not worry about hours of work, overtime payments over 40, etc., the position must, the duties must meet one of these white-collar exemptions and make the guaranteed salary. A lot of questions have come forth stating, well, Bill, if we pay someone $47,000, $476, excuse me, on a guaranteed basis, then we don't have to worry about overtime, correct? That is incorrect. The position has to meet or perform these duties, as we're going to walk through, and meet the salary requirement. So, for example, if you have a secretary who's doing clerical work and you're paying her in excess of $47,000 come December 1st, you're still going to have to pay overtime because the position is not going to meet one of these exemptions. So what are the exemptions? The first one is the easiest, but probably the most misapplied, if you will. It's called the executive exemption. Very simply, it's a manager, department head, supervisor, managing 2 or more employees, and the regulations specifically state 2 or more employees. Of course, we can combine part-timers if that's the case, and needs to be managing as a primary duty. Although the regulations don't state 51% of their work time being performed in management duties, if the Department of Labor comes in and audits you and interviews a manager, their first question is, Mr. Manager, Mr. Bill Ford Manager, what are you doing most of your time? Hopefully that answer he or she's going to provide is management duties. What are management duties? That's hiring and firing, performance reviews, discipline, coaching, counseling, training, scheduling, addressing issues, making decisions. That's management. Where we see problems would be, let's say, a warehouse supervisor managing several employees in the warehouse. But that person is also loading trucks or doing inventory or packaging or sorting or whatever it might be. Well, then that manager is going to lose the exemption because, in essence, they're not managing most of their time or as a primary duty. They're performing hourly warehouse duties. So if you have a manager managing 2 or more employees and they're doing lots of manual or non-exempt work or the work that they manage, be very careful. Another good example would be a maintenance manager. He oversees 2 or more employees, maybe hires and fires those employees, but ends up working and maintaining the plant or the warehouse operations or vehicles or whatever it might be. Second one is the administrative exemption. Now, after this call, you may go out and Google administrative exemption, and you're going to say, well, Bill, this is really easy to apply. I'm going to apply this exemption to a lot of my positions, administrative positions. Well, when you start looking at the Department of Labor opinion letters, their cases, their rulings, the administrative exemption is very difficult to apply. And basically what this exemption is, the position is someone who is in charge, maybe a department head, if you will, but doesn't manage 2 or more employees like the executive. However, they're making decisions on behalf of that organization, significant decisions. One of the best examples that I can provide would be maybe a chief financial officer who is working directly with the bank independently, managing cash flow or investments or certain budgeting requirements or whatever it might be. They're very high level. The administrative exemption is not your accounting clerk. It's not payroll. It's not many times a basic HR rep. It's not a purchasing person. It's not inside sales. It's not those types of positions. So be very careful about paying someone on a guaranteed salary basis who's in an administrative position, not managing. And that's where you may want to call or email me with your questions, because this is the most common issue that Wage and Hour finds in terms of non-compliance. So make sure that if you're paying someone on a salaried basis, that they're a very high-level position within the organization. Next is learned professional. I don't think it's going to apply within your all's industry, but basically the learned professional is for your doctors, your lawyers, teachers, etc. Next is the computer exemption. We see a salary paid to many network administrators, IT professionals, etc., and typically it's not compliant. To apply the computer exemption, we're talking about programmers. We're talking about program analysts, system analysts. We're not talking about someone who maintains our system, collects data, loads the latest software, someone who I call when my computer is down, maybe even someone who goes out and purchases our system and implements it. All of that type of work is typically non-exempt work. The next is if you have outside sales, and this is basically a hard and fast, very simple test. If someone is engaged in sales, and I'm not talking about PR, I'm not talking about glad handing or shaking hands, but making sales, taking orders, receiving and processing orders with clients, and they're doing that out in the field, away from the office. In fact, if they're in a home office, they need to be out of their own personal home office, but they need to be in the community making sales 51% or more of the work cycle. Now, this is the only exemption that requires no guaranteed salary. You can put an outside salesperson on straight commission. You don't have to worry about minimum wage. You don't have to worry about what they make. You can put a draw commission, salary plus commission, whatever scheme you want to put together for outside sales. There's no salary requirement. Then lastly, and rarely do we see this, and we don't want to confuse this highly compensated employees with our senior management team. It has nothing to do with it. But basically the government says if you're guaranteeing someone $134,000 come December 1st, and they show independent discretion and judgment in their position, then you don't have to worry about overtime. Again, we don't see that often because typically one of the other exemptions that we just talked about applies. So, you'll see on this slide the exemption or exemptions that we just covered. You're going to see the current annual salary is $23,660 or $455 a week, and the most significant change that we need to prepare for is moving to a new guaranteed salary requirement of $47,476. So, if you have positions that meet and perform the duties as we just described, executive, administrative, computer, professional, outside sales, and they're making $47,476, then you're okay. There's no questions, no concerns, etc. However, the one thing that we would recommend, whether you do it in-house or use someone else like SESCO or call me or whatever whatever you decide to do, always, at least annually, check your exemptions. Not obviously that we either do or don't make the salary, but check your positions and make sure that they're performing the duties that we just talked about. Especially if moving forward, let's look at an example here. Let's say that Bill Ford is making $47,000. I'm currently exempt as an because I'm making $23,660. And the organization, your company, is determining whether or not you want to increase me to $47,476 so that I continue to be exempt. You may want to double check the exemption status to make sure I'm exempt, because I'd hate to see you move that salary and increase it and still be in non-compliance because the position really isn't considered an executive as defined by the Fair Labor Standards Act. So it's always good to verify the exemptions. So obviously, the biggest issue is, well, I've got folks in my organization who are exempt, meaning that they meet one of the exemptions and meet the current salary, $23,660 or greater. But come December 1st, we need to decide whether or not we're going to increase them to $47,476 or what are our options. So if you have any positions that fall in this donut hole, if you will, the first thing that we would recommend, again, is review the exemption and make sure that the position is in fact eligible for the exemption. If the position is eligible for one of the exemptions, then what we recommend is, if they're not already, let's have that position maintain an accurate record of time. Let's see what our potential liability is first before we make any hasty changes. So we may go to Bill Ford, who's on a salaried basis, who's going to be making less than $47,476, and we may go to him next week, 1st of August or whenever it is, and we say, Bill, we want you to keep a time record. Now, we've got to be very careful here in that we've had some organizations very successfully request time records based on these new regulations. Some have caused some issues. So it's up to you on why you want to ask them to keep a record of time. It could be for benefit purposes or Affordable Care Act or whatever it might be. But typically what we find is an employee that has never kept time and now they will start keeping time because of these new regulations. They may pad their time. They may put down more time than is reality. So we need to make sure that we get true and accurate time records. And the reason why we're doing this is we want to see after a month or two, what are the hours worked? What does it require? What does the position truly require? So when you start clocking in and out as a salaried exempt manager, and when you're late, you start clocking in once you get in. Maybe you leave early, you start clocking out when you leave early. Maybe you've never had to clock in and out for doctor's appointments or otherwise. You may find that your hours of work actually are closer to 40 than you think. Of course, most employees, even me, we all think we work more than we actually do. So let's find out what those hours are. And let's say that maybe the records come in at 41, 42, or 43 hours. You may decide at some point to say, okay, well, Bill, we're going to leave you on the $40,000 salary. You're going to be non-exempt, meaning that you're due overtime, but guess what? You're not going to work over 40 unless approved. So that might be a possibility, is that you're able to reduce the number of hours worked and or restrict these folks to 40 hours per week, and thus you may not want to change the salary and put them on an hourly rate. Let's say that it's the opposite, though. Let's say that Bill Ford works lots of hours, and that's probably more common than not. Maybe I'm working 48 or 50, 55 hours a week, and there's not much chance that you can get my hours down. So then obviously you've got some questions, you've got some options. The first option is, well, we're not going to do anything. We're not going to make any changes. We're not going to start paying overtime. We're not going to increase the salary to $47,476. We're just going to hope that we're never checked, that the employee doesn't turn us in, etc. Of course, I'm not recommending that we're not recommending that as a firm, nor, although many of our clients over the past many years have been audited, and they'll say, well, Bill, we hear you, but I want to pay my secretary on a salaried basis. She likes it. I like it. We're not going to worry about it. And they've rolled the dice. But with this increase in salary coming this year, there's so much press, so much media, so much talk about it versus the years past, that employees are probably already wondering. So I would be very careful about doing nothing. Of course, you can always take that exempt person who's making at least $23,660 and increase their salary to $47,476 December 1st and continue the exemption status and thus not worry about overtime. But this, in addition to our compliance practice, this is where I really get aggravated with the federal government or state governments. What they don't understand, or what they don't care to understand, is that labor, wages, salaries, labor cost are our largest, many times largest cost, but certainly our largest controllable cost, meaning that other costs such as electricity or supplies or trucks or copy paper or telephones or internet, whatever it might be, all of those expenses or costs are determined by somebody else. Sure, we can negotiate at times, but basically we're going to pay what we have to pay for these expenses. However, we as an employer, it's up to us. We have every right to determine how many employees we're going to hire, how much we're going to pay them as long as it's minimum wage, what benefits we're going to provide, etc. And the difference between a very profitable and or mediocre company is how well we manage that labor cost. And if you will, there's information on the Department of Labor website that talks about, provides advice to employers about this new regulation. And basically their advice is increase the salary to $47,476. Well, obviously it's not that easy. And many employers are simply just not going to be able to go out and increase all of these salaries that much. There's just not that much in our margins to do so. So if you can't get someone to $47,476, just can't afford to do it, then you've got a couple of options. One is certainly change the pay plan, the current salary, to an hourly rate with overtime. In fact, you could say, well, Bill, you're making $40,000. We can't get you to 47, so we're going to put you on an hourly rate. But if you work these number of hours, including overtime hours, and you're going to receive this hourly rate, then we're going to get you to $40,000. And that's what a lot of employers are going to do, is come up with an hourly rate, come up with hours of work. Hence, again, very important to understand the hours of work that they're actually performing, record that we recommended, and come up with an hourly with time and a half over 40 that brings them back whole. And in fact, even if they don't work it, let's say that Bill Ford works 40 and only put in 40 hours, you can still have me turn in 48 hours if you want to get me to my $40,000. So you can back into it if you'd like. The thing with the hourly rate, most employees who've been paid on a salaried basis, they don't like that change. Their earnings are now at risk in their mind. They budgeted their life around a guaranteed salary. So that change can be very frightening. So if you move to the hourly rate, communicate it very carefully and how that's going to affect them. The second option, some of you all may be familiar with this. However, if you're using an outside, a third-party payroll processor, and I'm not picking on these folks, I'm just giving you some reality. ADP, Paychex, some of the other, if you're using any of these folks, they're not designed, their systems have not been altered, although they may sometime in the future, but not sure yet, to compute what we call the fluctuating workweek method of payment. But basically, this is a second option that you have, and that is the fluctuating workweek. What the fluctuating workweek is, you're going to continue to pay Bill Ford on a salaried basis. Again, you're not going to pay me the $47,476. We can't afford to get me there. But you're going to continue to pay me on some salary level, whatever I'm on now, currently, or maybe below, whatever you decide is appropriate. But you're going to pay a guaranteed salary for all hours worked. And since you're guaranteeing this salary for all hours worked, and by the way, that means if I work any part of a work week, and as you all know, a work week is a 7-day period, typically Monday through Sunday, Sunday through Saturday, etc. If I work any part of that work week, let's say that I come in on Monday morning, I work 4 hours, and again, I'm on this fluctuating work week, and I work 4 hours, and then I'm off the rest of the week, sick, and I'm out of vacation or sick leave or PTO, I'm out of time, the work week is still paid. You still have to pay me my weekly salary. So whether it's 1 hour or 80 hours, I'm still being paid my guaranteed salary that I was paid before. The only thing that you owe, in addition to the guaranteed salary, is halftime. It's not time and a half over 40, but halftime over 40. So, for example, I'm on a current weekly salary of $600. Again, I'm not exempt. You don't want to move me to an hourly rate. You're going to continue to pay me on a salaried basis. And let's say that for the work week, I worked 45 hours. You simply take the weekly salary divided by total hours worked, not 40, but total hours worked. For this week, I'm going to make $13.33 an hour. So instead of time and a half of that, you're going to pay halftime. So you take half of that, $6.67, and you pay that for the 5 hours that I worked over. So the overtime due is $33.35. So this can be a very viable pay plan. It's good for the employee because guess what? You're still going to earn your guaranteed salary. We're not going to put you on an hourly rate and put your earnings at risk. We're going to pay you a salary. And it's good for the employer because your overtime liability is halftime versus time and a half. So it really can be a very win-win situation if properly communicated. There are a couple of things that you need to be aware of if you use the fluctuating work week, and hence in its name, the first word is fluctuating. The hours of that employee need to fluctuate. If the Department of Labor audits your records and they conduct a wage and hour audit and they see Bill Ford, who's on the fluctuating work week, see my hours of worked, 45, 45, 45, 45, they're going to say that it's not a compliant plan, that basically I fixed a salary. So what they want to see is 38, 42, 26, 49. There's no such true definition of fluctuation, but as long as the hours change somewhat, then you're okay. So if you want little disruption, if you will, in the pay plan, you've got folks that maybe were working lots of hours, hours fluctuate, etc., then this might be something that you want to consider. But going back, basically, if you can't get to the 47, basic 47,476, basically you're stuck with an hourly rate with overtime or fluctuating work week. At this point, what I'm going to do is talk about some of the more common violations. Many of these are going to be reminders to you, but based on our auditing practice across the country, we've come up with 6 common traps or issues that I want to cover pretty quickly, and then we'll go to our question and answer. So the first trap, obviously, is we have misclassified someone as exempt. We're paying someone internally as exempt, meaning we're not paying overtime, we're paying a salary, and we're not paying overtime. This could even apply, and this will apply, even if someone is making $47,476 into the future, we misclassified that position as exempt, we are going to experience potential liability. And again, the common examples would be managers. Even though they might be managing 2 or more employees, they're performing non-exempt work. Maybe they're performing maintenance work or warehouse work or general accounting work, or whether it might any type of non-exempt work, and they do that most of their time. The other most common is paying an administrative employee on a salary without overtime. Folks like office managers, accountants, in-house, inside marketing, even marketing personnel, IT techs, etc. So that's typically the most common violation. So again, if you have positions who are currently being paid on an exempt salaried basis, which all of you do on this call, and if you're thinking about whether or not they're exempt or not, especially whether or not you can get them to the 47,476, suggest that you audit those positions to make sure that they are in fact exempt regardless of the salary. Number 2, and I had this case about a month ago. A little bit of background. I was auditing one of our larger clients. This business had 2 positions that were being paid an upwards of $80,000 plus. They've been with the organization for a number of years, very happy employees, but the duties they were performing were general inside sales, non-exempt work. So even though that they were $80,000 plus, they were still due overtime, regardless of the changes coming in December. So once the owner found out this, he went to these 2 employees, independently of us, and said, look, here are our options. What would you prefer to do? And those 2 employees said, boss, we want to be paid $80,000. We don't want to go to an hourly rate. We don't want to worry about overtime. We want our guaranteed salary, whether we work 30 hours or 50 hours. We're in good shape here. And they said, we would even sign a contract or a waiver or something legal that says that this is what we agree to. Owner calls us and said, well, Bill, I've got this figured out. These 2 employees are going to sign a contract. They're going to waive their rights. Well, if the Department of Labor, they may not complain, but if the Department of Labor ever came in for some other reason and they found these 2 employees, they reviewed their pay plans, they're going to say to these employees, guys, you all are due overtime back 2 years. This is the amount. And the employee's either going to say, okay, I want my check, or no, I don't want my check. And if they say, I don't want my check, then the Department of Labor is going to say, Mr. Employer, write us a check. It's going to the Treasury. So regardless of what kind of relationship you have with your employees, even if they're very happy with the way they're paid, if you're ever audited, you're either going to pay that employee or you're going to pay the federal government. Number 3, we need to be careful about what are hours worked. For non-exempt employees, we're not talking about salaried exempt employees now. We're talking about non-exempt employees, meaning that they're paid on an hourly basis with overtime. Need to be very careful about hours worked. For example, if we have meetings or if we send them to training or we have training in-house, or maybe there's travel time throughout the day, and many of you all have folks that are delivery. Maybe we're not paying for break time. We need to be very careful because most of these break time, travel time, meeting, training, most of these examples are paid time. You need to pay for someone who's in a meeting or being trained, or you got to pay for travel time. You got to pay for break times. You got to pay for folks working through lunches. Maybe you got a good employee. Maybe they're showing up early. I actually had this case with a very large call center. Employees were coming in. They were cutting on their light, cutting on their computer, and then waiting around until 8 o'clock started. Department of Labor said coming in, cutting on the lights, cutting on the computer, sitting at the desk was pre-work, hence paid time. So they had to go back and pay for all that time. Employees working at home. Of course, we have that nowadays given cell phones and computers and things of that nature. The other thing on lunches, for a period of time to be unpaid. Let's say that Bill Ford goes to his boss and says, look, I want to take a short lunch today. I'm going to clock out at 12. I'd like to come back in at 12:15 because I want to leave early today. I'm going to go pick up a child at school and we got to run some errands. And sure, no problem. Clock in and out. If the Department of Labor ever came in and audited your records, they would say you would have to go back and pay for that 15 minutes. For any period of time to be unpaid, it needs to be at least 30 minutes or longer, whether it's lunch, whether it's a break, whether it's personal errands, whatever it is. For a period of time to be unpaid, it has to be 30 minutes or longer. So monitor short clocks, if you will. We need to make sure that we're paying overtime. Again, this is for non-exempt hourly employees. We need to make sure we're paying overtime on all monies earned. For example, if we are paying any type of non-discretionary bonus, meaning an attendance bonus or a production bonus or sales, any type of bonus based on performance or behavior, that money is also must be included in the computation of overtime. And that can obviously be very difficult to do. For example, let's say in June, Bill Ford received $100 attendance bonus or a safety bonus. And I did work some overtime during those weeks in June. What you as the employer have to do, you have to prorate that $100 over the month of June, so therefore I made $25 a week. And if I worked overtime during any one of those weeks in June, you have to go back based on those hours worked and pay overtime on top of that bonus. That's probably the #1 violation for hourly non-exempt employees. We cannot average work weeks. Each week stands alone for overtime purposes, meaning that if you pay every 2 weeks, and I work 35 hours in 1 week and I work 45 hours the next week, the total is 80. You still have to pay the 5 hours over in the work week that I worked 45. There's no such thing as comp time, meaning if I work overtime, you have to pay it. You cannot give me time off later on. You're going to love this. The only organizations that can offer comp time are the government. They don't have to worry about overtime, so go figure. Trap number 5, be careful about deductions. We get calls all the time about an employee quit or was fired. They owe us money. They didn't return their uniforms. They didn't return tools, whatever it might be. Make sure you have authorizations for deductions, and also make sure you comply with various state laws on deductions. Some states are very strict on what we can and cannot deduct. Also, and although we don't see it much anymore, if you're doing any type of a loan, call it an advancement on wages. That way, if you provide Bill Ford a loan and you call it an advancement on wages and I don't show up and I quit, you can hold my last paycheck in its entirety. Number 6, This is another drumbeat of the Department of Labor. They're checking this because they want their tax dollars, and that is where employers are misusing independent contractors, meaning that someone is working for the company, performing some sort of service for the company, and you issue a 1099 and you treat them like a true independent contractor when they're really not. For an organization to be an independent contractor, it's very simple. They're really no different than you. They're in business. They advertise their business. They perform the same similar services to other businesses. They invoice you. Most importantly, they have workers' comp. They have a business license. They hire their employees, etc. So be very careful about hiring, I shouldn't say hiring, but paying an individual, maybe on a short-term basis or otherwise, or for a part-time job, paying those folks as an independent contractor. Because most of the time, if they're not in business and they're not truly performing services for the community, they would be considered an employee. And of course, if you issue a 1099, that's going to end up with the IRS, and that's how they track it. And if they say bill Ford, $500 cleaning the warehouse, and I'm not a cleaning company, they're going to go back. They're going to say go back and pay us the taxes and potential overtime and other things. So be very careful about your independent contractors and who you're issuing a 1099 and not. Some basic recommendations: always review your handbook. Review policies. Make sure you have good policies on wage and hour rules and regulations. Even in this day of electronic time records, find some way, either managers or preferably human resources, payroll, review and edit time records for lots of different reasons. Many times if an employee comes in early, first thing they're going to do is punch. They're going to clock in. Next thing they may do is go to the break room and hang out with the buddies until it's time to work. You have every right as an organization to edit that time record and change it to 8 o'clock or to whenever that person started work because they didn't perform any work. Also, editing time records allows you to monitor overtime, obviously allows you to monitor these short punches that we talked about, etc. Obviously, we recommend some sort of annual compliance assessment, and there's some other things there, but we're running a little bit at a time. So we covered quite a bit, somewhat A to Z in a matter of about 50 minutes. You see here on the last slide my email. Again, we provided the phone number, 423-764-4127. If you have questions that you don't want to ask here in a minute, feel free to call. Again, we're not going to bill you. This is not a scheme to try to get you as a client or anything else. This is just a courtesy for us being invited to present here today. So, Dan, with that, do we have any questions?
We do. We've got quite a few, and that was a great job. I really appreciate you taking some questions. The first one, I think you touched on what goes into the salary, but does holiday bonuses count towards your current salary, along with profit sharing, contributions, 401k match, health benefits paid for by the company, and life insurance? Does that go towards this current salary?
Boy, I'll tell you, that's a common question, and the short answer is, for the first time in history, and I did skip over that one slide, but because it's not that significant, but possibly. For the first time in history, the federal government is allowing employers to credit a non-discretionary bonus, meaning some sort of production bonus. I'm not talking about a year-end Christmas bonus, bless your heart bonus, pension, 401k. I'm talking about a commission earned, a bonus earned. They're allowing up to 10% of that commission to be applied against the $47,476. So you literally could have someone who is in a production situation, a commission situation, who is on a salary of maybe 45, 46, somewhere in there, and they earn additional commissions, you can apply up to 10% of those commissions to get you to $47,000. So there is a little bit of leeway there. However, this year I was sitting with an employer, literally in tears, the Department of Labor sitting there telling this owner how much he owed to employees, and he was in tears because, hey, I have paid some of their education. I give them a pension. I give them 401k. I pay 100% of their health insurance. Some of these folks have vehicles. It was the saddest thing to see because he was so good to his employees. However, the government is going to, they do not count any of those things as part of compensation. So you may have a very rich benefits plan, but you're not going to get credit for it.
Well, on the subject of bonuses, we do have one more. As you know, many bonuses are paid out at the end of the year, contingent on year-end results and goals. With the 10% of the bonus, our current salary employees would hit that 476 threshold, but they would be making less than the 913 weekly. As long as they end up making over the 476 when counting the 10% bonus at the end of the year, are we okay?
No, you're not. The requirement that the government has issued on applying this 10% bonus is that you, as an employer, have to assess the salary threshold on a quarterly basis. So you have to look at it quarterly. And if Bill Ford, with his salary and commission on a quarterly basis, didn't make the 47,476 on a prorated basis, then you have to bring me up to that 47,476 on a prorated basis each quarter. So what you'll have to do is look at that annual bonus and that probably to a quarterly type bonus.
All right, and just a couple of more. Why do exempt personnel need to document their hours worked?
They don't. The recommendation we're making there, if that's what this question is designed to, is that if you have an exempt salaried person currently who's exempt based on a salary level of $23,660 or greater, but it's less than 47,476, then we recommend, it's not required, but we recommend that you keep a time between now and December to sort of gauge how many hours that person is working, what options do we have, what pay plan changes would make sense, etc. So it's not that truly exempt folks, have to keep a time record. I'm just talking about these folks that fall in the donut hole so that we can have good information and data moving forward. Let's say that we can't change Bill Ford from $35,000 to $47,000, and thus I'm going to be non-exempt and I'm due overtime. Come December 1st, I'm due overtime. And then all of a sudden in January, February, March, I start working a lot of hours because I'm getting time and a half over 40. Well, guess what? You now have a benchmark, time record benchmark that we ask you to keep between now and December 1st that would help prevent that. Hey, Bill, well, last year in 2016, you only averaged 42 hours. Now you're working 46. Why are you increasing your hours? So that is also one of the advantages of keeping the time card is if we have to go to an hourly rate, we have some basis, again, for hours worked. Okay?
Got it. Now, just a couple of more. I guess this might be more of opinion than answer, but do you think a typical inside salesperson can be categorized as an administrative exemption?
No, zero chance.
Okay. Now, the last question I see is, can I just pay someone the new salary of $47,476, then I don't have to pay them overtime, correct?
Correct. Again, as long as they're making the $47,476 and in bold and performing one of the exemptions that we just talked about. executive, administrative, outside sales, etc. Okay?
All right, well, that looks like those are all the questions we've got. I want to thank Bill Ford with SESCO Management and everyone else for taking part in this webinar. As we said earlier, this has been recorded, and we will have a recording momentarily for folks to review it, which we'll be sending out in the coming days. Thanks again.
Thank you.